Hey, Steve Saretsky here. I wanted to put together a video on foreign capital. Obviously, it's influenced the Vancouver real estate market. There's always two sides to the debate, and it's funny to still see people try to downplay the role of foreign capital in the Vancouver real estate market. Basically, in a lot of these global cities, real estate markets, you had the board, a lot of these real estate, you know, industry people, etc., try to downplay the role of it, saying it was only 5% of the market. Of course, the developers are saying what money laundering and we don't sell pre-sale condos offshore, etc. All this stuff, and it's saying that it's a supply shortage. Again, the reason why I put these videos out is to educate. I think to me, it infuriates me to see this narrative that's being pushed that is, in my opinion, it's total BS. All you have to do, and it's either these groups, either these real estate development groups or whatever, are only truly care about their own self-interest and they're just pushing their narrative, or they're completely clued out. The flow of money that has left China in the last couple of years is very well documented. And so it's not just Vancouver real estate markets that have been propped up by it. You can go look at it globally: Australia, New York, Germany, Sweden, the UK. It's very evident. It's happening in all these major global cities, and so it's truly fascinating to watch some of these groups downplay it and say that it's not a big factor. You know. Before when the foreign buyer stats first came out, Richmond had 25% of their transactions from foreign buyers. Again, that doesn't even include people that have their visas or that are using shell companies that are using the son or daughter that actually have their citizenship here. So the number is actually probably much, much higher than that. Again, just to put that into context for everybody, just so they can understand this. If you go look at any investor, any sort of macroeconomic data, the flow of money coming from China is very, very evident over the last couple of years. And you eventually go down this rabbit hole and you try to figure out, well, what has caused the money to leave China? You can only justify a shortage. Again, we're currently building record number of new condos under construction, record number of housing starts over the last couple of years. You're going to try to build enough supply to meet the demands of speculative behavior. People are trying to buy 2, 3, 4 condos, trying to build for that. It'll never happen. And so the only way to justify an increase where you saw Richmond detached houses shoot up by 80% in 3 years, it's not supply. So, again, watch the Chinese market. So I'm just going to go into a little bit of details here and again, so it's funny to watch some of the comments, I guess, from people that really don't understand financial markets or that really don't understand. So, I've penned a couple posts about these outflows from China, and people go, and I say, the role of, foreign capital, and they go, oh, well, Steve, why are you saying it's Chinese money? That's racist. Well, it is. The money's coming from China. We know that. So it's not racist. It's merely pointing out facts. And so it just comes down to people not being educated on where the money is truly coming from, and actually watching and studying financial markets. So just to put into context, since August of 2015, it's been estimated there's been $1.2 trillion that has outflowed from China into the global economy. And so again, you can do the math. Where does $1.2 trillion go? Well, a lot of it went into real estate, which is a popular Chinese investment. So you can go look at all these luxury markets that saw a massive increase in price and sales. New York, again, Vancouver, Sydney, Australia. 1.2 trillion. It was estimated by the National Bank of Canada that in 2015, $12.7 billion flowed into Vancouver real estate, which basically equated to 33% of the total dollar volume. So again, $12.7 billion of Chinese money went into Vancouver real estate in 2015. Numbers probably higher in 2016, and again, I've talked about this in the last couple of videos. That number has really slowed in 2017. Again, you can see it from the feet on the ground. You can go to the open houses. You can see who's buying. The foreign capital has definitely dropped off. Of course, it's still playing a factor, but you saw this basically slow down. China started to tighten its capital controls, so they're trying to keep money from flowing out of the country. Obviously, again, like I've said, China has the single largest credit binge in history, the single largest credit growth in history. It makes Japan's in the 80s look pathetic. And so, yeah, I mean, it's quite obvious when China's made this easy access to cheap credit, they've been on this absolutely massive, credit binge. Where does the money go? People, and they pegged their currency. They were talking about, off the U.S. dollar. And so all this money started to flow out of the country and into these safe assets, which, again, Vancouver real estate, Toronto real estate, you do the math. So, again, this is very, very simple stuff. There's a site called google.com where you can actually go and research all this. So, again, these are stats from National Bank of Canada, Financial Times, New York Post. It's all very well documented. So, to really downplay the role of foreign capital in the market, and to try to keep pushing this supply narrative is the stuff that makes me want to come up with these videos to really get the message home that, again, these people are saying, oh, there's race baiting. It's not. It's literally money coming from China. It's truly mind-boggling. Anyways, so I think that's something to watch for, again, from a global perspective. So China, again, has tightened their capital controls. That's why we've seen a cool off in Chinese money, not only in Vancouver from the foreign buyers tax, but also because of that. That's why you're seeing luxury real estate markets, so the high-end stuff is starting to cool down in, again, cities like New York and Sydney and all that stuff. So watch for that. China's tightening their credit controls. They're actually beginning a deleveraging process, which Kyle Bass, who is one of the most well-respected hedge fund managers in the States, he calls it that China is basically going to have a credit crisis or a banking crisis there because their credit growth is too much. Anytime you start to, slow that, again, just in China, they've in order to grow their GDP, they've basically done anything and everything, and they've built these ghost cities on this massive credit boom. Even the Chinese developers are actually going out there and saying, oh, this is the biggest bubble in real estate history here in China. So basically, anytime you start to deleverage the credit, I think that's massive cause for concern. And obviously, there's implications of that on the Vancouver real estate market, and hence why China is beefing up their banking reserves. Because they're beginning this deleveraging phase. And this is something Kyle Bass talks about in a video that I'm going to clip in here, that this potentially, he feels that it's going to start a credit crisis in China. And, again, don't take this from me. This is, again, from one of the smartest, well-respected hedge fund managers in the States. He's the guy that shorted the U.S. housing market in 2006. And so I think he knows a thing or two about the markets. So I'm going to clip that in here in a minute. But yeah, I basically just wanted to put this video together to sort of shoot down that narrative where, the only way to get out of this is supply. And for anybody that says that, Chinese money is influencing our market is racist, it's total stupidity. It's people that don't understand markets that really can't look and see what's going on. So again, like I said, $1.2 trillion has outflowed from China into global economies since August 2015. Again, in Vancouver real estate, right when it started to go up, go look. I put all these charts on my website. You can see when the sales to active ratio started to go up. You can see when we started to get multiple offers. It was early in 2015. And of course, we saw 12.7 billion. It's estimated 12.7 billion was injected from China into the Vancouver real estate market. So I mean, again, the numbers are there, but a lot of people, don't want to do the homework, and they'll take a message that's jammed down their throat from the development industry. So, anyways, here's Kyle Bass on the credit binge and crisis coming in China. And again, if you don't think this is going to affect the Vancouver real estate market, you might want to think twice. Again, we don't know how this is all going to play out, but I think it's very important to watch, and I think that it's truly fascinating. So I think that you have all these people. I mean, you can see it in the detached market. People are holding out and that are holding these $3-4 million properties that are sticking to their prices, thinking that the money is always going to be there. We've had this massive inflow of money coming from China that's pushed these prices up. And so I think for people that are holding on, expecting that the money is going to be there in 2, 3, 4 years, it very well might not. Certainly money from China is going to keep flowing into real estate. But to think that there's not going to be a slowdown, to think that the deleveraging China won't affect real estate markets globally, I think is it's incorrect. But anyways, here's Kyle Bass. Enjoy the video. Hopefully he explains it, and talk to you soon.
Kyle, we've seen some interesting developments in China lately. A regulatory crackdown on the shadow banking system, but the way the Chinese government is going after it is by preventing the banks from making these investments. What are they called? Entrusted investments that underpin what's called the WMP market, these wealth management products. You've been taking a close look at it. How serious do you think this is?
Eric, I think that when you look at the WMP market in China, the way you think about these products is they're basically levered money market funds with dubious assets, and they're basically asset liability mismatches, right? They're buying a long-term asset with very short-term liabilities. That's ballooned in the last few years to 30 trillion yuan, or call it $4 trillion. Imagine $4 trillion worth of assets, investments in these kinds of products. And what's happening is some of the longer term assets aren't doing very well. And as soon as the liabilities have problems, meaning the depositors decide to not roll their liabilities, all hell breaks loose. And so think about this, 4 trillion on a banking sector of 34 trillion. In the US, our asset liability mismatches at the peak of our subprime greatness were 2% of the system. So we're talking about more than 10% of their system.
So here's the problem with a forced deleveraging, which is effectively what this amounts to. It can often get out of hand. I guess, are they going to blink?
Yeah, I mean, as you can imagine, if you remember how in the U.S. how everything unraveled, as Warren Buffett famously said, you see who's swimming naked when the tide goes out. Correct. Things got to be pretty dubious early on in some of these big mismatches. And what we're seeing now, we saw Minsheng Bank just a few days ago say that they sold a 3 billion yuan, call it $500 million worth of WMP, and they actually never invested the money. It was just a ghost WMP. And so what's interesting about that is now you've seen in the last couple of days Anbang, who, as you know, bought the Waldorf and has bought strategic hotels, and the life insurers have been raising money in China by using these short-term liability products. That's how they've raised the money for these acquisitions. And so
another asset liability mismatch.
$300 billion. And so the Chinese insurance regulator was just detained and arrested for corruption. And now it's rumored that some things going on at Anbang. And so what you start to see when liquidity dries up is all of a sudden people start going down, companies start having problems. This is the beginning of the Chinese credit crisis.
We're seeing it. You believe that we're seeing it now?
Sure. So what
because we've been talking about the inflation of the bubble,
right? But the timing's really hard, right? This is 10 years in the making, and I'm not good enough, and very few people are adept enough to decide when it exactly happens. But if one were to say that the system is running out of money, running out of cash, and it's too levered, what would you see happening? Well, one of the charts that I gave you is the chart on the interbank corridor. You would expect interbank lending rates to spike every now and then. And in March and the end of March, you saw the cleared interbank rates spike over 9% when the corridor top is 3.45. So what happens when you have a max levered system with interbank funding and your interbank rates spike from 3.5 to 9 and settle at 5? Well, if you're levered 3 or 4 times, it blows you up. And so what we're seeing now are spikes through the corridor, and that's the evidence that liquidity is a liquidity problem.
So you can't declare it with certainty, but it feels to you, I'm just trying to get this, it feels to you like we're beginning to see the bursting of the credit bubble.
Yes. I don't know how long it takes.
Could take a while.
Things typically unwind a little quicker that they get put together. But, think about the U.S. We had our first bumps in the road in February of 2007.
Right.
And we had
full-blown credit crisis by September of 2008.
We didn't have Bear Stearns until, March of 08? We had Lehman in September of 08. So even a large unraveling takes a while.
How is it that on the one hand, you can have a guy like Mark Mobius from Franklin Templeton, who is a China bull, say that this is overdone, this is overdue, this is a good thing, this crackdown on the shadow banking system, and at the same time have someone like yourself, who has, let's call it, a bearish view on Chinese credit, talk about this as potentially the beginning of the end?
Oh, I wouldn't say it's the end. I really think, Eric, I just think that it's a cycle, and they're going to go through a credit cycle. And a credit cycle means they let it grow too big. They grew it too recklessly and too quickly. And so we're just going to see a restructuring of their banking system. That doesn't mean the end. So I agree with Mark on that. The degrees of severity of the decline are, I guess, open for debate.
Okay, but if there's going to be something of a crisis in the banking system, would you want to be long A shares on the mainland market, which is what he's buying? Probably not. Probably
not. And what's interesting is, if you've noticed, last night, 4% declines in the index. What you're seeing is with the insurance company problems with their liabilities and the banking system's problem with WMP liabilities, what would you expect to see happen? You would expect to see liquidation of some of those assets. So you're seeing a divergence between the A-share market and, let's say, the Globe. Right? The Globe's been running on a high of the French election. It's been running on better GDP prints in Europe, inflation prints in Europe.
Tax reform here in America.
And yet China's going the other way, and people are scratching their head. Well, the narrative between, let's say, the public narrative of China's getting better and they're going to grow GDP a little faster and manufacturing's doing better, and the reality of their credit system are diametrically opposed to one another. You have corporate bond issuance was negative in the first quarter. You can't grow M2 or the broad money at 12, 13% while M0 is declining and corporate credit's contracting. So as a macroeconomist, these things you can't square that circle.
Of all the indicators we've been discussing in the course of the past few minutes, which ones right now are most important to focus on?
My own view is both cleared and uncleared interbank lending, right? If the whole market is wholesale funded, which is kind of what we're saying, and if banks stop trusting one another, which is what we're seeing, to your point, the entrusted loan market, the big policy banks are pulling back the entrusted loans to the other banks because they were keeping these WMPs off balance sheet, right? So if they stop trusting one another and start pulling in their horns, well, then that's how it happens. So you look at the interbank corridor and watch if rates spike.
So far as I understand, for the most part, we've talked about this in the past, you've expressed your view on China through Asian currencies. Many of those currencies actually strengthened in the first quarter. The Hong Kong dollar weakened. Do you feel confident, if this is in fact the beginning of the bursting of the Chinese credit bubble, that those positions are going to start to work out well?
Without talking about what we do, because we shouldn't talk about these things, but I think more broadly, That's right. You look at the currencies will be the ultimate arbiter of the credit system, because what will the Chinese regulators do? What will the PBOC do? They'll expand their balance sheet. They'll recap the banks. They'll drop interest rates. They'll do everything that they're supposed to do to fix this. But what does that mean the Chinese currency's worth? That means it's worth a lot less than where it is today.
Now, there's plenty of speculation, and there has been for a long time, that President Xi isn't going to let anything disorderly happen in China. If, in fact, that's true, is an orderly unwind of excess leverage in the Chinese system just as good for you in the long run?
Yeah, I mean, look, whether it's good for me or anybody, this is going to happen, right? President Xi, look, he's there to make China great again. He's there to consolidate power. And the 19th National People's or Party's Congress is in November. So he'd like to hang on until November. The question is, when you have a $34 trillion credit system and you're juggling 5 or 6 balls at once, if one of the balls hits the ground, you're going to have a less orderly system. And so I don't know the answer to that other than get through November is what he's trying to do.